Uber reported earnings before the bell and the stock was down 2.5% when the S&P 500 was up about half a percentage point, and we are going to talk about it. We're going to talk about Uber's earnings. Was this move warranted? Is Uber a buy now on this weakness, and what the stock will do for you as an investor over the next 5 years? But before we dive in, guys, could you please go ahead, like and subscribe? It really helps me out. Now, Uber reported very mixed earnings according to the headlines. Now, if you actually just exclude the analysts' expectations, Uber grew revenue 14% on a year-over-year basis and reported EPS of 83 cents. EPS in the same quarter last year was actually negative, and that is why we don't have a growth estimate, but mid-teens growth, very solid. However, it missed the analysts' expectations here on the revenue side, beat on the earnings per share side, and then the guide came in a little bit weak as well. At the midpoint, Uber guided for pretty much $2 billion. The market was looking for 2.06, 2.07 billion. They did miss, however, they're still guiding for a beta of 31% growth on a year-over-year basis. Gross bookings beat expectations at 46.2 billion, and that would represent 18% year-over-year growth. Uber don't guide for revenue. So look, very mixed results, but the underlying fundamentals of the business continue to improve. If you look at the quarter as a whole, gross margins actually expanded. Very good stuff right there. EBITDA margins expanded by a lot. Free cash flow margins also expanded, and this translated into net dollar values increasing significantly. In Q1 2024, Uber's free cash flow was 1.35 billion. Now it's sitting at a hefty 2.2 billion. EBITDA went from 366 million to 1.4 billion in the quarter, and the company sits on a very good cash pile of 6 billion, about $9.9 billion in debt. Very solid earnings. I mean, the operating leverage in this business is absolutely insane. Despite missing the analysts' expectations, the underlying fundamentals of the business literally continue to improve. And then just breaking down the guidance figure just a little bit more, you could see a gross bookings. They're looking for 16 to 20% growth, 18% at the midpoint, 31% here for adjusted EBITDA. These are the figures they were looking for, and they did anticipate a 1.5% currency headwind to total year-over-year growth, 3% for mobility. Diving into some of Uber's KPIs, monthly active platform customers, MAPCs, was up 14% on a year-over-year basis. Trips was up 18%. Gross bookings was up 14% and revenue was up 14%. And as you can see, when you have such robust growth with strong cost discipline, you're going to get adjusted EBITDA that grows 35%. And the reason why we're seeing such robust growth in Uber's platform is because they're kind of expanding wherever they can. You know, they're not just doing trips. They're not just doing fast food delivery. They're expanding into grocery, pet, convenience, alcohol, home improvement, electronics, doing last mile delivery. For merchants, you know, it's direct pickup, dining, advertising, offers, data and analytics. You know, all of this is just expanding the TAM for Uber, and that's why they're growing. And at the same time, they're expanding their partnerships, providing value to the consumer, to the merchant, to the platform itself, as well as starting to get into last mile logistics right here, which is going to be their next growth driver, and could even see their freight side of the business growing thanks to this ship day, ship it. This is actually very bullish for Uber as a whole. Looking at their revenue breakdown per segment, mobility was up 15%, delivery was up 18%, freight was down 2%. And this is why I spoke about the freight segment earlier. You know, if they can really reinvigorate this side of their business, they could actually see continued growth and continued margin expansion, because this is the one poor segment of the business. It's their freight, and their total revenue is up 14% for the year. Now, along with 14% in revenue growth, expenses only grew 3.4% on the same quarter. And if you look right here, general and administrative SG&A was $1.2 billion last year in the same quarter, was now $657 million. They halved their SG&A cost. Extremely great cost discipline. And that is why we actually saw income from operations increased 648%. Uber really building a lot of operating leverage into their business, focusing on cost discipline. And that is why you actually see diluted earnings per share going from negative 32 cents in the same quarter last year to 83 cents this quarter. However, shares outstanding did increase 2.4%, and they did buy back about $1 billion worth of shares. So there's a lot of dilution going on. And that is this point right here. However, they do have a number of other highlights. Waymo vehicles in Austin are completing more trips per day than 99% of human drivers, which is absolutely incredible because there's 1% of drivers that are probably working like 18 hours a day. That's insane. There are plans in motion to scale hundreds of cars in Austin before launching in Atlanta later this year. So it does look like Uber is still the preferred provider when it comes to tapping into their install base. The delivery segment showed robust growth, 45% in adjusted EBITDA, indicating strong demand and operational improvements. They're buying back a lot of shares at the moment, and Uber Eats is coming to Turkey. They're looking at buying this Trendyol acquisition. It's just sort of like an Uber Eats variant in Turkey for 700 million. So it does look like they're expanding sort of to those Gulf areas, and I think that's probably going to open it up to maybe stuff like Greece, the Middle East, and you can build on from there. Now, if you are an Uber investor, what are some stuff to watch? I would keep watching deals, okay? Deals and acquisitions, particularly when it comes to autonomous vehicles. This is a big threat for Uber. It's something you need to pay attention to very, very closely, because if we start seeing Waymo build out its own Uber app-like capabilities, that could be detrimental. However, if Waymo keeps partnering with Uber, that is a tick. So these are the two things you want to watch. I think you also want to watch margins, right? We did see a lot of operating leverage. I think that's going to slow down in the years, but you do want to see if margins expand, because that is ultimately the investment thesis for Uber, right? Revenues growing, margins are expanding, means the stock is cheap, and that is going to deliver you outsized returns in the years ahead. And then you also just want to look at currency headwinds. Now, Uber's moat continues to remain narrow. I think it's unchanged, potentially widening, but unchanged for now. And the Uber thesis is intact. Now, where does that leave us with valuation? For Uber over the next 12 months, they're trading at an EV to EBITDA of 19.3 times, price to earnings of 23.3 times. So not crazy for a company growing in the mid-teens and guiding for that revenue growth roughly as well. A shareholder yield of 1.71%, and they're mostly just buying back a ton of shares. They don't pay a dividend, and they're not looking to really pay down any debt right now. Now, looking at our valuation framework, you guys know how we do it on this channel. We get a revenue figure forecasted to 2029, apply a free cash flow margin, and then we get $18.25 billion in free cash flow. Guys, that is a 3x if you look at margins expanding to 20 times to 20% here in 2029. You're literally going from a 6.3 billion to 18.2 billion. Immense growth right there in free cash flow margin. Then if you apply an EV to free cash flow multiple of 17, the current multiple is 23. So we are looking for a little bit of multiple contraction. Subtract the net debt, you get the equity value. And then by 2029, you get $157 in earnings per share. The current price is $83 as of the most recent close. And that's how you get 13.5% compounded annual growth rate over the next 5 years. You can actually get a little bit more if multiple does expand or if the margins improve and beat to the upside. I think this growth rate is looking a little bit frothy. I think you might see like 16, maybe 15% growth up until 2026, but this will very slowly slow to low double digits in 27, 28, 29. So this valuation might not be the best. Nonetheless, Uber does look attractive. And is Uber a buy right now for me? I would say definitely yes, but I would just want a little bit more margin of safety. And that margin of safety, when you look at the charts, is probably around here. You know, if we get back into sort of this, like I would say mid 70s area, that would be a great place to buy. This is a 200-day moving average. If we pull back here, find support, you could see we did trade in this range for the better part of the last year, maybe 18 months. If we find support right here, this will probably be a great place to get long, and then looking 5 years out at that $150, $140 price target. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.